Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Rob Beardsley. Thanks for being on the show again, Rob.
Thank you very much.
Rob has quickly become an expert in a topic that's so important in our industry. And the last time we had on the show, it was a very popular show, and Ryan even told Rob that yet, but it was a very popular show. And even from what he said, it was you all responded in a great way. And because he is he's become an expert, like I said, on his topic of underwriting. And it's a quality that you have to have, or somebody on your team has to be really good at underwriting to be successful in this business. And so I would encourage you to go back and listen to our first show. We talked about underwriting there some, and it was, like I said, so popular. I knew it was good to have him back. And a little about him, in case you missed the other show, he oversees acquisitions and capital markets for Lone Star Capital and has identified, negotiated, and structured over $100 million worth of multifamily real estate transactions. He has evaluated thousands of opportunities using proprietary underwriting models. Also helps run Green Oaks Capital, his family's real estate investment advisory firm. So, Rob, thank you again for your time and being willing to come on and share your expertise. You know, let's just jump right in, or maybe you can give us an update on Lone Star Capital and what you all are up to right now. But I'd love to just dive into the underwriting.
Yeah, let's dive in. And like you mentioned, our first episode was also pretty brass tacks. We talked about real performance indicators and things that you could really use right away and use to evaluate and understand deals better. And I definitely don't want to repeat things that we talked about last time. Hopefully just have new discussions and new ways to identify value and whatnot. But as far as Lone Star Capital, not much has changed since we spoke. We're growing in assets under management. We're growing in our team, adding more people to help us on the acquisition side as well as the asset management side. And so we've got some exciting growth and things coming in the works that I don't want to quite announce yet. But I guess when I say not much has changed, it's just because I'm looking in my little day-to-day work and I don't see the bigger picture often just because I'm working at the task at hand. But no, it's exciting things that are happening.
Nice. Well, maybe we should just go ahead and say, like, you are also publishing a book on this topic exactly. And we want to go through a little bit of that today. Is that right?
Yeah, that's right.
Awesome.
So just, to say something quickly on that, like we talked before we started recording, so much I get people reaching out saying, well, you learned this stuff and you must have read a book or taken a course or watched a video or podcast series and that's how you learned, right? So what are those resources? Just shoot me an email and then I'm good to go. And unfortunately, that's just not how I learned, and not for a lack of effort. I searched for the answers and really didn't find the most straightforward way to learn underwriting and analyzing deals. And obviously there are resources out there, and there's also boot camps and people charging thousands of dollars over weekends or even multiple weekends to learn. And I never was able to attend one of these. I'm sure they're helpful, but I'm really excited to be able to now share this book with people that ask me this question and say, hey, this is not going to be the end all be all for you, but it's a great starting point, and I think something very digestible, whether you're just getting started or even pretty advanced.
So, and I know it's going to be popular because it is such an important topic, and it seems like there's a big mental block for most people when it comes to underwriting. And just what you just said, like, where do I even start? How do I even know what to look at? What should I even ask for? Where do I put in all these numbers? What do I even use to figure out if this is, a good deal or not? And so maybe you give us a minute or two on, how did you learn how to do this? How did you get into underwriting and become very proficient at it?
Yeah. So really, spreadsheets and math numbers have always been an interest of mine, and I love figuring out how things work. I love the black and white nature of math, rather rather than the kind of the shades of gray of writing, although I've learned to love writing, especially about the topic of underwriting. But I started out just through trial and error and being thrust into it. I was working with my dad on multifamily acquisitions, and he was very intent on my learning it myself and building my own underwriting model. He felt that if I went out and learned it on my own and built my own model, I would understand it better, which at first I thought it was crazy. I thought it was just way too much work, because why would I not just take the existing model out there that somebody already built and just run with that? Because why would I spend all this extra effort? But he was actually so right. In so many more ways, it's been so helpful to build my own model, which helped me learn the basics, learn the underwriting, and then actually be able to evaluate other people's models and just deals in general. And of course, that model has iterated over time to become a whole lot better than what it once was. And then just like you said earlier, underwriting thousands of deals, you learn so many things, and not being afraid to put myself out there. So when I was first speaking with brokers, I'd be kind of scared to provide my feedback and say, well, I think this deal's worth 15 million, because what if they laugh at me or think I'm crazy and I'm way off on the value? So being able to have those conversations and actually support my valuation and say, well, I think the payroll is this, and the stabilization timeline should be 18 months versus 12, and kind of support those different things, that's really helped me over time.
Okay. Wow. Yeah. Underwriting thousands of deals. That's definitely a way to learn a lot about underwriting. But even going back to, I know a question that I often get to is like, well, which model do you all use? Do you use this guy's or, this guru's or, whatever, all these different models that we can come up with, right? Or we can, and I've heard other people say, well, you should build your own. And that does seem so daunting. If I had think right now of how building my own, even now, I would think, man, that's going to take me a while, that is going to take a long time. But you're definitely going to understand the model a lot better, right?
Yeah, I think, and another big benefit of building your own, and I don't want to make this a show about why it's so great to build your own, because
right.
It's not, like you said, it's a huge time commitment. And if you're not trying to, if you're just starting out, I'd say, yeah, it's a good exercise, because it's almost like a class, right? But if you are running a business and you don't have time to step away and, pull out a whiteboard and kind of brainstorm how you want your model to look and all this stuff, maybe under quarantine now you do, but it's in terms of practical application, it doesn't always make sense to build your own. But one of the benefits of building your own is exactly how it works, and you can similarly create that same confidence just through using another model and getting comfortable with it, and just through repetition. So if you take any model, right, and like you mentioned, there's a guru model, or there's this standard model, or this preferred model. And if you underwrite one deal through it, you really have no idea if that model then spit out 20% IRR. You say, well, is that good? I mean, I know 20% generally is good, but for that model, is it good? And how is it really calculating that IRR? So only once you've underwritten, and in the book, I said 100 deals. I think that's kind of a lot. But if you've underwritten 100 deals with the same exact model, you'll really understand what a 20 IRR means in that model. And so what I explain in the book is it becomes less about the numbers and more about the kind of the bell curve of returns. So if in your model you've been underwriting hundreds of deals through all these deals you're receiving from brokers, and most of the time you get a 10 IRR or a 12 IRR, and then all of a sudden a 15 pops out, say, wow, that really sticks out. And then you have a special deal. And that 15% IRR may not sound amazing to other people who are using a different model that might have different, more aggressive assumptions, but you just have to get to know your model.
Okay. No, that makes complete sense. And I know the listeners are wondering right now, well, how's Rob underwriting deals today?
Okay. Yeah. Good.
Like I was just thinking about that, and I'm like, I get that question as well. I had an email today from somebody asking me about, well, what are you all doing right now? How do you even know what the value is? What's it going to be a month from now? And so, I just thought of that, and I know that's what they're asking. And so why don't we just jump into that a little bit and it provide value that way, and they're going to just see how, that you are an expert in underwriting. I'd love to hear what you're doing, just how you're underwriting deals right now.
Yeah, so today we're sitting in mid-April 2020, right in the middle of the coronavirus pandemic, and the transaction volume has gone way down. So we're seeing much less deal flow than we just a couple months ago were, right? And on top of that, we're being even more selective with deals that we're even willing to underwrite. So our universe of deals has significantly shrunk, and then our personal universe of deals that we're willing to seriously consider has shrunk. So we're really underwriting far fewer deals today than before. And then in terms of how we're underwriting them, I've gotten this question also, like you might imagine, a lot as well. And the thing that feels the most natural to me in terms of how are you incorporating the uncertainties of the future as well as potential collection loss in the immediate term. And my answer really is to not look at that and focus on that quite as much, because if you're underwriting on a 5-year or a 10-year horizon, this is going to be a small circumstance in your overall business plan. And even more so much of returns, depending on your business plan, are derived from your exit assumptions, right? So you may have cash flows ongoing, first year a little lighter, second year grows, but the real driver of returns, especially for value add deals, is your exit. And so if you're planning on exiting in 5 to 10 years, coronavirus is not potentially not going to impact you whatsoever. So if you have a 2-year business plan or a 3-year business plan, I would say you would really want to stress that one, because that's obviously much more short term. But so to answer your question, we've been looking at deals on a more long-term horizon because we want to be able to weather the storm. And then you have the debt side of the equation. And that's what's really been shaken up. Pretty much the only game in town right now is Fannie and Freddie, and their loan terms have varied significantly, and they've cooled down or they've calmed down, spreads have come down, and it's become more normalized lending environment. But you still have the big reserves, which you are potentially aware of. And those reserves are holding back a whole lot of debt proceeds, which obviously directly impact your levered returns. And just off the debt, having that reserve hold back and having a little lower leverage point, because the lenders are going, instead of 75% LTV, now 70% LTV, that right there is knocking potentially 10% off value. So if you have a seller that really wants to transact today, just accounting for the debt side, that they're going to lose 10% of value. So, and if you start factoring in a worse economy over the medium term due to coronavirus, then that should be another 10%. So there's really a whole ton of uncertainty in valuations, and sellers aren't readily accepting 10% lower value today, right? They can just say, well, okay, I'm not going to sell. Just like we are actively buying and selling the market today, we're choosing not to sell a property that we previously had on the market because the market has changed on us and we're no longer happy with the terms available in the market, right? And we would much rather just continue to own our properties and continue to manage and operate and wait for a better time. So it's going to take a more prolonged situation for sellers to really bring down their pricing assumptions about their own properties. But so that's why I don't think hammering deals super hard on the operational side is really going to do you very much good, because the debt side's already doing that for you. And the bid to ask spread is just getting wider, and you're not going to get a deal done.
I love that outlook. And just right away, you talked about, okay, we're not going to focus completely on the uncertainty of the next couple of months, because we have to think about it and plan for it if we're closing on something right now, of course. However, if you're doing a 7-year deal, I love how you said, 7-year hold, 10-year, whatever. This is really minor. Should be really minor anyway, in that entire business plan. So, and actually a couple other things I wanted you to elaborate on it, just because the debt side is so important. I mean, all the time, but especially at the moment, right? Things have changed so much. So you talk about like the spreads coming down. I know we use terms like that all the time, but what does that mean, to somebody that's just listening right now?
Yeah, no, good point. So uh, an all-in interest rate. So if you are going to borrow money for a multifamily investment from, let's say, Fannie Mae, and you'll get an all-in interest rate of, let's say, 4%. And that all-in interest rate is comprised of an index rate as well as a spread. And that spread is a credit spread, and that represents the lender's risk premium that they want to achieve. So if a lender is lending on a 10-year term, their index rate or their base rate will be the 10-year US Treasury yield. And let's say that is at 80 basis points, which is 0.8%. And then they're going to put their spread on top of it. And if we're getting to a 4% loan, to make the numbers easy, let's just say a 1% US Treasury and then 3% spread to get you to an all-in interest rate of 4%. So when you're talking about the loan environment, you could have volatility in your index rates. The US Treasury yield is going up and down and really volatile. And then on top of that, you could also have volatility in spreads. And that would be in the lender's appetite and demand for making loans. So if lenders don't want to make loans, they'll just widen out their spreads and make their pricing uncompetitive and discourage borrowing. And similarly, if a lot of lenders are competing for business, they'll compress their spreads, which is effectively reducing their own profit because they're always going to be making profit on top of their base rate, right? And they're borrowing at an index rate and then making money based on their spread. So that's what we're talking about when we're talking about spreads. Have initially, when there was a ton of uncertainty in the market and things kind of really kicked off in the pandemic, spreads gapped out over 100 basis points, which is a huge move. And it was funny because at the same time, as you know, when investors flee from risk assets, right, they might move out of stocks and into bonds, which drives the 10-year Treasury yield down. So we had a big downward move in Treasury yields, but a gap up in spreads. And so people thought, well, the 10 years down, I should be able to borrow cheaper money. But no, actually, borrowing costs went up all the way up to 5% at one point. So it's been an interesting environment.
So, give me a minute or two also on just the reserve holdback you talked about.
So I think this is a genius implementation by the agencies as a way for them to keep on lending in such an unsure environment. So rather than them pulling back to such low levels of leverage to really make their financing unattractive, or to widen out spreads and make interest rates really high, or just decline making loans, they've implemented a holdback of reserves that include your property taxes, your insurance, your replacement reserves, and of course your interest payments. And that's a hefty holdback that they're doing for potentially 6 to 18 months worth of those costs, and which could amount to 10% of the loan amount being held back as initial reserves, which really gives the lender comfort that even if you don't produce any cash flow because you have very high delinquency and your collections are way down, they'll be able to continue to fund the loan out of those held back reserves, which is a good thing for them. And it's not necessarily a good thing for you, because if you were counting on every last dollar of leverage and you're only getting, right, if they're already pulling back leverage from 75% to 70, and now you're getting 10% of that held back in reserves, you're only getting 60% on your value, which just a few short months ago, people were being levered up to 80%. And the really interesting thing is it's pretty straightforward to talk about the numbers, like 80% to 70% to 60%. The really insidious thing, or thing that is not as easy to see, is what was the value of that. So back then, people were lending at 80% of value, and value was an inflated appraised value. And you could kind of manipulate the underwriting to really push and squeeze the value and get a lot of leverage. And now, even without really hammering the LTV, lenders essentially could keep their LTV the same at, let's say, 75%, but because of the way they're underwriting, they're pulling everything back and getting more conservative in every way, and really constraining in how much they're willing to lend. So it's amazing to see in this environment, that even with some small tweaks, without really going out there and saying it explicitly, like, hey, we're not making loans, or we're only making loans at 60%, you could see everything tighten up even just behind the scenes.
So how does that change the type of properties you're looking for, the requirements of those properties that you're starting to underwrite? Like you said, even the deals that not only has the deal flow shrunk, but just the deals that you're willing to go through the process of underwriting, how has that changed?
So we're definitely moving up in quality. So I think,
Why?
right. Sorry?
Why moving up in quality? When you say up in quality, you mean like maybe we're looking at A class where before we were looking at B minus and C?
Right, exactly. So it's just the higher quality assets are typically just more resilient in recessions, in uncertain times, and also not to say that there's going to be pain in any particular asset class or category A, B, or C. Everybody's going to see price declines. Everybody's going to see some level of distress. It is just an opportunity to get into some nicer properties that we were previously priced out of. And certainly on the Class C side, there will be deals that were over-levered, that were particularly impaired because of a lack of collections and unable to service debt. And there will be some distressed opportunities. I don't think it's going to be widespread, but there will be some unique opportunities, and they'll most likely be on the worst assets, which we will not shy away from. We will definitely be looking to actually buy the debt from lenders to then foreclose ourselves on these distressed assets, or buy them from the banks, and make attempts like that, which will definitely be more so occurring on the worst quality assets. But in terms of buying something today before the distress has really hit and before material price declines have come, I definitely see that making way more sense to do so in the Class A, A minus, B plus space than looking for a C asset right now before prices have really adjusted to where it becomes attractive.
Nice. So I love what you're saying, but but that goes right into, what do you see over the next few months? When are you all going to be very serious about buying again, or maybe you're serious now? Maybe you could elaborate on that, or are you going to wait 3 months?
Yeah. So it's funny because if we look on LinkedIn or Facebook, there's people out there saying, "Wow, there's great opportunities still out there in the market," and things like that. And I really don't think so. I think it's a very difficult time to be buying right now, just because unless you have a seller that's working with you on like we said, a 10% price adjustment roughly, because the debt market alone demands,
right.
The change of conditions on the debt side alone demands a 10% reduction in price. So unless you have a seller that's working with you on that, it's very difficult time to buy. And so we're really hoping that we'll be able to get back in the market in a meaningful way in the next 3 months. And I think that'll in part be determined by the debt markets. When are bridge lenders going to be back in business, CMBS, and when do the reserve requirements burn off from agency loans? I think the debt markets will lead the way on that. But yeah, we're definitely looking every day. We want to understand the market, but we're not really expecting to find anything in the near term.
So tell me a little about how your underwriting, say, 3 months ago, or the types of underwriting you were doing then, helped you prepare for what's happened now.
Yeah, so I think we're definitely all in this together, and we're all learning together, which is good. And some stuff I wish I would have done more of before, and some stuff I'm just learning as we go. But I think something that's really straightforward is just having ample reserves. And our rule of thumb pre crisis, it was to have, for permanent loan deals, loans that were typically less leverage and longer maturity, so overall lower risk, we would have a reserve account of at least 1 month of operating expenses. And for bridge loans that were generally higher leverage and shorter term, so they had maturity risk and things like that, we would do 2 months of operating expenses as a reserve. And now that that we're all in the middle of this, I'm thinking, well, maybe it should be 2 months and 3 months. So upping that reserve. I know a lot of people are talking about reserves now and how invaluable they are, and it is really true. So that is something that we were doing before, but I think it can't hurt to do even more of. And it's on my list of things to do and write about, is to actually perform an analysis on the return drag of having an extra amount of reserves, what it does on the returns, right? Because if I have to hang on to an extra $1 million in my reserve account, obviously that's burning on my pref and it's dragging down my returns, but is it worth it? And so it's an analysis that I want to do in the near term to understand that better for myself. So that's number one is reserves. And I would say what we were doing before, I would say we were always, as you know, generally conservative. So not reaching for the stars on our pro forma rents, and being more realistic on our economic vacancy, and not forgetting to factor in things like rent concessions, employee discounts, and model units, and bad debt. Just making sure that we have enough vacancy cushion there to incorporate all that. Because I think right now we're seeing, obviously rent growth is stalled, and all that is, really what's making a lot of deals 3-6 months ago look good was big rent growth and big rent increases from renovations. And that was something that we always shied away from. We pretty much always underwrite our deals with just 2% rent growth and 2% expense growth. So we're really looking for the deal itself to be able to pencil on its own.
Nice. Okay. I'm grateful for you explaining that. Even going into the reserve, how you're calculating reserves too, because that's always a question I get as well. And I ask operators on the show, and you're one of the few who actually has a way of saying, well, this is how we calculate it, right or wrong. Like, you have a way that you methodically think about it, and this is how we've done it. And I feel like that's good, because if something happens that teaches you, well, maybe that wasn't as much, or maybe it was too much, or whatever that may be, how you were calculating it. So now you have a point to go from, at least to make it improve, And so, we're about out of time, unfortunately. But I'd love to hear a little about, I know you go into this in your book as well, but just sensitivity analysis a little bit, and maybe ones that maybe you just give us a minute on what that means exactly. And then maybe, different analysis that you stress more than others that we definitely need to watch.
Yeah, definitely a fun topic. So sensitivity analyses are really just different tests and tables that you can create and evaluate to sensitize your returns across various outcomes and assumptions. So you could sensitize different vacancy rates and see how that affects your returns. And you could really look through the different assumptions and see which one it affects your returns the most. So there are some things that just by exploring, you can see that they don't really affect your returns that much. So if you miss on your CapEx budget, and this is what I've found just through underwriting so many deals, if you're off by a few $100,000, obviously depending on your deal size, but a few $100,000 on your exterior CapEx budget, it's not going to kill your deal. So people say, well, what if there's, the parking lots are bad and you have to redo them all for $50,000? And you say, well, it's not the end of the world. It's, not really going to change your returns that much. But if you're off by $25 on your rent pro forma, that is a huge deal. So we've got $25 or $50,000, right? And there's just different ways that assumptions affect your underwriting. So my favorite sensitivity analysis is the exit test. And this is something that's a must for lenders. And I think it's really important for borrowers as well. But it's basically your ability to exit the loan that you are planning to put in place. And the way you do that is essentially you take your existing loan that you're planning, or your proposed loan, and you determine its maturity. So let's say you're going to take a 3-year loan or a 10-year loan. You're going to pro forma out your P&L out to that maturity date of 3 years, 10 years, 5 years. And you're going to see what are my projections at that maturity. And with a base case assumption about the capital markets, about what are interest rates going to be then, what is leverage going to be, and different requirements like that, and see what is my new loan going to be, and is my new loan going to be greater than my existing loan? Because if it's not, you're going to be in trouble. The lender might force you to sell so they can get their money back, or you might have to come in with fresh equity, do a capital call, which nobody likes. So I think refinance exit tests tell you so much about the risk of a deal, especially if you're taking on a bridge loan, because a bridge loan has a much greater maturity risk than a 10-year loan, because in 10 years, almost all deals will be in a better position than where they are now today. But in 3 years, especially with a bridge loan, which really is lending based on future, you really want to stress and see, well, if I'm off on my rents, if the market isn't as frothy as it is today and cap rates are up and my valuation is down, am I going to be able to refi out of my bridge loan, or am I going to get hung and have to come in with fresh equity, be forced to sell it at the worst time? So that's my favorite stress test.
Awesome. I appreciate you going into that. I know lots of listeners have questions about just how we check how sensitive the deal is and our underwriting. So incredible, Rob. One final question: how do you like to give back?
How do I like to give back? Well, I think right now I'm definitely in the stage of my life where I'm still trying to learn from mentors and soak up everything I can. So I'm not always thinking about giving back, but what I am always willing to do is jump on a call or answer someone's question. And often I get an inquiry that I just can't see how it could add any value to me, and I'll still just get on a call and share my knowledge freely and give candid advice and really just try to be helpful, because somewhere in me is a teacher, and I do enjoy that.
Awesome. Rob, I know this will be a popular show. Everybody is trying to just hone their skill of underwriting and get better at it. And I know your book is going to be very popular amongst the listeners and myself. I can't wait to get it. I hope you're going to send me a copy, or I hope it's autographed as well, by the way. But anyway, Rob, grateful for your time and grateful just for you sharing on the show and giving back in that way. Tell the listeners how they can get in touch with you and let them know how to find your book, because by the time they hear this, it's going to be out there.
Yep, I'm working on it right now and really excited for it. So I highly encourage you to head to lonestarcapgroup.com. Right there at the top or anywhere else you'll find it, you'll see a link to click to get a free copy of my underwriting model sent directly to you. And then from there, there'll be additional information on getting my book and just getting more involved in what we do. And if you want to email me directly with any questions, you can reach out, rob@lonestarcapgroup.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.